Hey guys, my name is Max Convexity. I hope everyone's having a great day. I wanted to speak a little bit on the sustainability of these funds. All right, so when it comes to the sustainability of the funds, of all these covered call funds, a lot of it has to do with the actual distribution policy of the fund. I thought Larry Kim from Simplify made some great points about this, about Simplify's distribution policy, and I believe the things he's saying applies to all the covered call funds. I just want you guys to listen to this and let me know what you guys think.
Would be a shortfall for a given month, because I've noticed that the distributions look almost exactly the same every month. I take it that's not a coincidence.
SVOL's distributions are managed. So we set the distribution amount equal to the fund's expected long-term carry, which is the income from the fixed income portion of the portfolio, plus the income earned from the core VIX future strategy. We keep the distributions relatively stable and don't make big changes from month to month to make it simpler for investors to plan their cash flow and, frankly, to make it easier for them to understand the product. So in some months, the fund will pay out more than it actually earned, but in other months, it will pay out less than it actually earned. Over time, the goal is for the distributions to closely match the actual carry.
The amount of return of capital for...
All right, so this is what Jay does too. I think this is an industry-wide practice. When you're shorting volatility like SVOL does, they call it carry because that you can rely on volatility to go down. It has a carry. They talk about a carry trade whenever you can. Usually the carry trade is like when you can borrow, when you can short yen at one place, you go short the dollar to yen, but then you're long the pound to yen, and you make a difference you make a guaranteed profit on the middle. Well, that's not exactly how selling options works, but there is a profit that you can rely on when you sell options. We've covered this a million times. These funds have numbers. I always talk about Monte Carlo estimates and all kinds of other crazy stuff, but these guys, I believe, do this on purpose. It's industry-wide, and I don't think it's anything bad that Defiance is doing that other ones aren't doing either. Larry Kim seems like a very sober and thoughtful person. That's a really good interview, and I really like SVOL, and I really like Larry Kim. He's very impressive. But he talks about SVOL's distributions being quote-unquote managed. Well, like I say, the managed part, that's the whole key to the sustainability is how they're managed. It's an industry tactic. They all manage distributions. Look at JPQ and JPI. They give you about half. Same thing with QYLD. They give you about half. With Defiance, they have a different distribution policy where they're going to pay all the distribution. They aren't going to give you half. They're going to give you the whole thing. So let's listen to Larry a little bit more.
Hypothetically, if an ETF was distributing a lot of investor funds back to the investors over a long period of time, what would be an obvious indicator of that?
The most important indicator for SVOL, or for any funds for that matter, will always be total return. Total return is the truth serum of the investment world. It reveals all. I mean, suppose a fund has a 12% yield, which sounds great, but a 10-year average annual return of 1%. Total return, reveals the truth, right? So if a fund does not have an attractive total return over time, then all the distributions in the world and how they're classified simply don't matter.
I see. Well, the current yield is a bit over 16% as we record this, and that's been somewhat typical for the fund. I ran the total return for the year 2023, and it was just under 20%. So that would mean, because the total return was higher than the yield, that the net asset value actually increased, and you obviously weren't, at least for the majority of situations, returning investors' funds back to them.
Yes, that's correct. Just keep an eye on total return over time. And by that, I mean years, not months. SVOL, like any equity-based fund, will have down years as well as up years. But just keep an eye on the return.
I thought that was interesting. It all comes down to total return. So look at a fund like QQQY. They have what, 50, 60% yield. Some months it's 60, some months it's in the 50s. But you could say it's reliable at 50% yield. And yes, that would be bad if their total return was negative, especially in a year where the market was up 50%. But for one thing, they follow they follow the NASDAQ. The NASDAQ was up 50%, which is true, but they were only around for about a fourth of a year so far. So in that time, they have about a 28% total return if you annualize it. They're killing it. 28% total return with the 60% distribution, 50% distribution. That's good. That's sustainable, or that's good. Like he says, it's the truth serum. That's why I focus so much on total returns, and that's all. When I'm talking about tracking error, that's all I'm doing is I'm looking at which assets perform the best in relation to the parent asset, including the dividend, because that matters. And you add them both together, and they still don't perform as well. Like I say, we know that covered call funds generally do not perform as well as the parent, but you still want a covered call fund to perform as well as it can. And you want one that can pay the highest dividend, in my opinion, that's sustainable. I think QQQY is doing exactly what they were designed to do. In my opinion, let me know in the comments what you guys think. But total return is the true serum. Those two things about how when Larry explained the managed distributions and the total return truth serum, those are things I've been trying to explain in my videos for a long time, but I don't have the vocabulary, and I have been doing a bad job explaining it. So I thought I'd show it to you guys. Maybe you guys will believe him if you don't believe me. Or you know what I'm saying. I'm not saying don't believe me, but it's just somebody else to listen to. And like I say, I really like Larry Kim. That's a great, you guys should go watch that entire interview. But watching that interview got me thinking, and that's why I made this video on sustainability. And then it got my mind thinking, and I went down some other rabbit holes. But so here's my thought. So the stock market is built on averages and rules of thumb. You hear it all the time. You never go broke taking a profit. You hear little rules of thumb all the time. Never, always dollar cost average. Never never go into a whole position all at once. All these things. Well, so that doesn't mean just because the rule of thumb can be a true fact. It can be a good thing to do. You never go broke taking a profit. Always dollar cost average. It means it works over the average circumstance. It doesn't mean it works in every circumstance. There's a huge difference between average results and then what ends up happening. And that's the thing. No one knows what's going to end up happening. So in the markets, you're dealing with average results and rules of thumb. The dogs of the Dow. I don't know if any of you guys have heard about that strategy, but what you do is at the end of every year, you look at the 30 Dow industrial stocks and you pick the stocks that are paying the highest dividend. And I think you pick the 5 or 10 of them. I think it's 10 of them. Anyway, in their studies to go back to the 30s, if you would have done this, it beats the market by a mile. It has a great CAGR, great risk-adjusted return, great everything. It doesn't mean it works in every year. If you would have done that in 2008, it wouldn't have worked out very well for you going through the 2009. If you would have tried that in 2022, would not have worked out very well. It doesn't mean it's a bad strategy. It's a great strategy with great long-term average results. Big difference between average and what actually happens. And I think that we get hung up too much on what actually happens and then want to throw the baby out with the bathwater, so to speak. I have some other examples of this, and I'm going to get to them in a second. But first, I wanted to talk about something else that deals with average results. Okay, I'm convinced the JEPI and JEPQ, if you stuck a gun to my head, those are the best funds. And iSpy does the same thing, so I'll throw them in there too. And there may be other ones too, QQQI, or I'm sorry, it's not iSpy. I wrote the wrong, oh my gosh, I wrote the wrong thing on my slide, SPY-I. So SPY-I, JEPI, JEPQ, they use a monthly out-of-the-money covered call strategy. And I think that the managers of these funds, they look back at the studies, and over the past, I saw a study that I'm going to show you in a second that goes back 38 years. And it's amazing how well that strategy does. Okay, it's called the BXMD, and right here, the BXMD. Let me see if this is the right one. Yes, the BXMD is the strategy where you do monthly covered calls on a 30 delta. So 30 deltas, is out of the money 5 to 15%. Where have we heard that before? That's kind of what YieldMax does, and it's definitely what JEPQ and JEPI and SPY-I do. The out-of-the-money covered calls. It's just a great strategy. Look at this. So this is from 1990 to 2018. The BXMD, which is the monthly strategy, average return 9.59, right? S&P 9.29. It beat buy and hold. That's amazing. Buy and hold usually beats everything. I mean, that is absolutely amazing. I'm totally 100% convinced that the managers at JP Morgan have also seen this study and a lot of other ones, and they're making those funds to recreate, to try to recreate this. This is a hypothetical index, but they're trying to recreate it, in an ETF package with real money, and I think they're doing a great job. Now, does this mean I don't like triple QI? Or I'm sorry, does this mean I don't like QQQY? No, I still like QQQY because I'm extremely conservative, and the options that use the shorter time frame generate a lot more buffer, therefore a lot more yield, and therefore they have a lot more downside protection. This BXMD does not give a lot of downside protection. I'm going to show you that in a second. But as far as if you're trying to worry about making money on the average, not every year, but on the average, we're talking from 1990 to 2018, this strategy kills it. But it doesn't mean it's going to kill it for the next 38 years. Maybe these past 38 years were an anomaly. We don't know, but I just think this is a pretty good indication. Now let's look at some other things. I had some other things on here I wanted to show you with the benchmark strategy. Okay, so here's the BXMD. So here's the beta, which is the relationship to the S&P. So it gets about 82% of the movement of the upside, of the S&P. It has a lower standard deviation than the S&P, so it has better risk-adjusted performance. But you can see it has the best risk-adjusted performance. Actually, the put right fund is one better, but 1/100th, 1 basis point better. But anyway, it's a great idea. No one would doubt that. Let me show you a time when it did not work. Let's look at when this fund was first introduced, JEPQ. So this is the NASDAQ out of the money monthly covered call fund that I really think these guys are basically just trying to beat the freaking buy and hold by recreating this back test or recreating this hypothetical strategy. And I like the idea. These guys have, 38 years of data on their side. So it's a great idea. So if somebody comes to me and tells me, hey, these guys are opening up a fund, on April 29th of 2022, and gives me that back test, I'm going to be super excited. Well, what happens? It dropped 20% in the next, 6 months. Granted, the market dropped a little bit more. The market dropped like 22%. This caught about 9/10 just because we saw the beta, right? That's where the beta comes in. It caught about 9/10, 8 or 9/10 of the upside, 8 or 9/10 of the downside. Well, does that mean I was stupid to buy this fund? No, it has 38 years behind it of average results. It doesn't mean doesn't mean that my results are going to be exactly like the average. What a lot of people probably would have done is got disgusted and sold it. And look what happened. No one would. I'm trying to use JEPQ because I'm trying to stay away from the funds that I like to talk about defiance and stuff, but I think everyone can agree that JUPI and JUPQ are kind of the gold standards of this type of fund. So that's why I picked this, because it definitely would have been the wrong decision to get out. In fact, you should have bought more while you were down here. But a lot of people that I run into since I started this YouTube channel, if their ETF drops 5%, they'll dump it. I mean, and that's fine. Yeah, everyone has to do you, but that's not the way. I don't think that's the way these are designed. These are buy and hold. It's because these option selling strategies anyway. They have so much data behind them, and they have so much edge in them because you're selling something that you can buy back for nothing most of the time a few days later when you're selling this out of the money option premium. Extrinsic premium, there's drive down the street in Chicago and you see a lot of big houses in the suburbs of Chicago that are built with option selling premium. You go to Scottsdale, it's the same way. Go to West Palm where Jay lives, or I think he lives in West Palm. That's where Zega is. But it's no wonder that there's a few towns in the world, Scottsdale, Greenwich, Connecticut, West Palm, probably also somewhere in Southern California, where 9/10 of the money managers live, because they can live anywhere they want. There's probably a lot of them that live in Austin too, but they can live anywhere they want. I mean, that because it's so profitable. Let's look into some other average results, and let me try to make maybe some better cases. But I wanted to wrap up on this slide. So we know it's been the best strategy for 38 years, but it may not be the best strategy in the future. But what are you supposed to do? In the market, you have imperfect information, and you have to do the best with that information that you can. I always like to say you don't know what you don't know. And that sounds stupid, but think about that. You don't know what you don't know, right? I mean, how can you know what you don't know? Correct? I mean, I think it's correct. So right now, I wonder if we're on the eve of a global recession. I wonder if it's a 1999, 2000 style crash that's coming our way. I don't know if you guys remember, but Intel took like 17 years to get back above water. And it's not a bad company. It's Intel. They make all the computer chips they make half the computer chips in the world, especially especially 10 years ago. I mean, but that just goes to show you how bubbles can happen and stuff. If I told someone to buy Intel in 2000 and it took them 17 years to break even, does it mean I'm stupid? No, Intel's still a good pick, and if they would have held it, it's doing great now. I mean, but I can't know what I don't know. I remember when I was in financial planning, wealth management. This is around about 97, about midway through the the bull run in the late 90s, which was amazing. It may have even been more crazy than it is now, but I don't know. It's pretty crazy now too. But anyway, I remember people would ask me all the time because I was a stockbroker and they thought I knew something, which of course I don't. No one knows anything. Your broker's broker because he's broker than you are, and that's the way the market works. We're all dealing with imperfect information. No one has any idea. None of these people on YouTube know. They're all just giving you results based on rules of thumb, and I am too, and average results. I can tell you what's the best thing to do on average. I don't know if it's going to be the best thing to do next year. Whenever somebody used to ask me what stock to buy, I would always either say Dell or Intel. Okay, well, I remember there was this one guy whose account I always wanted. He owned a big company, and I always wanted his account, but I never did get it. But I finally got it because one night he saw me, probably in '99, and he said, I remember you told me a couple years ago to buy Intel, and it's like up 5 times since you've said that. And I just shrugged my shoulders. I go, yeah, great. It was I hope you got some. He goes, no, I did. But he goes, I'd like you to manage my money for me. So he was using his own recency bias or whatever. So I ended up getting the account. My thing is, whenever now somebody asks me what a good stock is, I have no idea what the market's going to do tomorrow. But I say Nvidia's, or I say Tesla. Those are the stocks that was like Intel was back then to me. Intel and Dell were back then. Just a slam dunk stock. I mean, Nvidia and Tesla. How do you go wrong? And even if you are wrong, I mean, what do you do about it? So like with the global recession, let me show you guys something here. All right, here's a chart of the NASDAQ. It's not just Intel. The NASDAQ index, the great mighty NASDAQ index, took, peaked in 2000 and took till like 16 or 17 to recover. But since then, it's tripled. I mean, but then it's tripled in 8 years since then. The NASDAQ's a great index. There's nothing wrong with it, but it wasn't a great index for a while. Look at let's look at our friend Intel. These are monthly bars. It's the same thing, but look at this poor son of a bitch up here. Somebody owns Intel and probably still owns it at $76. But anyway, so if you look at Intel, well, it still hasn't recovered all the way. It's not a bad company. I thought it had recovered, so it still hasn't recovered. But it's a great company, and it got me that guy's account probably because I recommended it here, and he talked to me here, and it's a 5-bagger. If you bought it here and held, you're still all right. But this also speaks for diversification, because you can have the best stock in the world, and it can have a bad run of luck like Intel did. But if you own some other semiconductor stocks too, you were fine during this period. Average results are just average results, but no one can know the future. People just can give you good ideas and stuff. Just keep that in mind. So right now, my theory is yes, we could be on the eve of a global recession. Absolutely. And I remember in 2022, so we're talking more than 2 years ago now, there was a Wall Street Journal article that came out that said 95% of economists said we were going into recession in 2022. Well, the recession never hit. Granted, we didn't have a great market, but you certainly didn't want to sell and get out or anything. 2022 was a gigantic buying opportunity. You have to. I think a lot of people, especially on the internet, don't understand that two things can be true at the same time. You can have a great investment idea, and it can be a great idea or a great plan or whatever, and it can still you can still get bad results out of it, or vice versa. You can also have terrible ideas and get good results over them, and that gives you confirmation bias. It's probably going to piss a lot of people off, but if the market crashes tomorrow and we drop 40% in one day or something, I'm going to say, well, it had to happen sooner or later. I mean, it's been supposed to happen. A lot of people thought the market was over and done with in 2020, and really, the end of 2019, December 2019, is a lot of people thought the bull market was going to end there. December of 2019 was a bad, or maybe it's 2018. Yes, December of 2018 was a pretty vicious pullback. But then we rallied for another couple of years, and then we hit COVID, and that was a vicious pullback. But then we keep rallying. My point is, it doesn't pay to get short. Well, you can't make any money. Yes, it might crash tomorrow, but wonder if every time I thought it was going to crash, if I bought puts, I'd be broke. Really, the only way to make money is buy and hold. Now, does that mean buy and hold works every time? No, of course not. Nothing works every time, but it's going to give you your best average results. So my theory is the market's going to crash when it's going to crash. Buy and hold quality companies and indexes for the long term. And when you can, put option decay to work for you by doing option trades, by buying these new covered call funds. These make it a lot easier to put decay to work for you, because there's a whole new category of ETFs, and where that's all they do. So I wanted to say, so we established JetQ and SPY may have the best set of factors for average profit over time. How will they do next year? We can't know, but we can make, well-informed decisions. And I've already showed you the chart of how JetQ performed in 2022. Nothing was wrong with JetQ. In fact, it's great. But yeah, it was down 20%. You would have thought something was wrong with it if you didn't have a longer-term perspective like I do, and that's what I'm trying to give you in this little talk. Okay, so I don't know if you guys saw my earnings trade today on Mara. Well, let me show it to you real quick. Because I don't care. It doesn't matter about it. I don't know anything about Mara either, but this is perfectly representative of my philosophy. Okay, so I put on a trade with a profit loss graph like this. The white line is where we're at now. That's where the stock was at when Mara was at when I made the trade. So, and just goes out till Friday. I think Mara announces earnings either today after the bell, they may already be out, I don't know, or tomorrow before the bell. In any event, what I like about this trade is it has a huge edge. If the market goes nowhere, I make $200, $139. The market goes up 15%, I make $638. The market goes down 15%, I lose $305. The market goes down 20%, I lose $350. If the market goes up 20%, I make $500. See what I'm saying? I don't know which way it's going to go, but this is like flipping, heads and tails this is like shooting dice with dice that are loaded. That's all I want is I realize I have no idea what Mara's going to do. I could have done this trade in reverse and guessed the downside, and it doesn't matter. It's going to go up or it's going to go down. I know that for sure. Call it 50-50. It's an even shot which way it's going to go. I just choose up because we're in a bull market, and generally, you look what happened in NVIDIA last week. I think it's better to choose up, but philosophically, it does not matter. I just want a 50-50 trade where I have a gigantic edge like this. And if I can do this trade enough times, I know I'll make money. And it's the math that's going to make me money. I want math to make me money. I know that the knowledge isn't going to make me money. I have no idea in the world what Mara's going to do. Neither is anybody. And if anyone tells you, yes, people can take educated guesses, and I'm not saying there aren't smart people, but I hope you get my point. I'm sorry if I'm kind of ranting. I'll try to stop. So let's see what else we need to talk about. Okay, well, yeah, this is my philosophy. So once I gave up and surrendered to having to know everything, I had to know everything back in 99, 2000. In that time frame, I thought I knew everything, especially in the mid-90s and stuff. I think by the early 2000s, I started to figure it out. But I can't tell you how much money I lost thinking I know everything. And making trades based on, I'll look at the chart here, pull back here, I had no idea. No one has any idea. Once I started breaking it down to math, I became a lot happier. And also, you're just happier in your personal life. When you surrender to the fact of you don't know everything, it's so empowering. It's one of the greatest decisions I've ever made, and it showed through in my trading results. Because now I look for trades like that Mara. That may not be the greatest trade, but you guys get my point. I look for a trade, the gigantic built-in edge. That's why I like QQQY so much. That trade has a gigantic built-in edge. All right, guys. Like I say, I hope I didn't rant too much. I appreciate you guys for listening to me. I'd be anxious to hear what you guys have to say. I'd love to know you guys' philosophy and the rules of thumb that help you out, or if you believe I'm wrong, if you do believe that you can know which way the market goes. I may be wrong about it. Maybe there are people that know. Maybe you know which way the market's going to go. I don't know. But that's my philosophy. So I wanted to get that out there. You guys have a wonderful evening, and I will talk to you later.